morning. Welcome to a brand new week of Trading Hour. I am Reema Tendulkar. With me are Pavitra Parekh and Sumaira Abdi. Good morning, girls. We've woken up to an onslaught of global news, but the markets at 11 a.m. look a lot better than they did when we opened up, or what the SGX Nifty was suggesting. The low on the Nifty was 17,166. From that level, there has been a recovery of nearly 150 points. You can't see it given the context of the decline, but there has been a recovery of close to about 150 points from the day's low. And as we speak, we're down close to about 1.5% on the benchmark indices. That said, we're still not out of the woods because the Dow futures is suggesting a cut of 200 points after the 1,000-point knock that it had in Friday's trade. But it's going to be a heavy week in terms of cues. So let me quickly outline what we need to watch this week. So today we've got the Reliance AGM that starts at 2 p.m. The India Q1 GDP is on Wednesday. On Thursday, we'll get the August auto sales numbers, which will start trickling in. And then the all-important U.S. jobs data, the non-farm payroll data, will come out on Friday. In fact, it's going to be the global macros which will dominate the sentiment in the month of September. There are no big domestic cues which are lined up in September. What's the street going to watch in terms of as feeders into the FOMC's next meet? One is going to be Friday's non-farm payroll data, and then you've got the CPI inflation print for the United States for the month of August on 13 September. That's going to be very, very crucial, and these will be the two data points which feed into the FOMC meeting on the 20th and 21st of September. The question is, if the markets got what they were expecting, why this reaction? What changed in the FOMC meet? Well, for the first time, the Fed chair has acknowledged that there is going to be demand destruction, that there is going to be pain to the households in terms of the spending power, etc. And that's going to hurt. Then it feeds into the corporate profit. So for the first time, there was an acknowledgement that demand is going to hurt. And, based on his commentary, it seemed to suggest that even if that's the case, they are going to persist till inflation hits that 2% mark. There was another very strong statement which came out from an ECB, Isabel Schnabel, who is urging policymakers to act forcefully to bring down stubbornly high inflation back under control. And she's warned against retreating at the first sign that price pressure may ease. So she's saying that even if global markets get into a recession or you get signs of inflation easing, she's saying don't step back, do not pivot, continue with taming inflation. And that's a pretty strong statement coming out of, the ECB. And this will be an important feeder into the ECB central bank meeting, which is on 8th of September. Well, that's a lot of global, market updates that we've given you this morning. But let's hear out Jay Powell's remarks that we got on Friday and Saturday.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy.
All right, and it is all of these comments which really led to that big rout that we saw on Wall Street. On the back of that, all of the Asian markets were well in the red at the start. But, like Reema was pointing out, there has been a recovery in the Indian markets. There's also been a recovery across the Asian markets. So a few of those will come up for you. And you can see that we've moved up significantly from the day's low. So do keep those on your radar. For our own markets, if you take a look at the sectors, of course, the banks are doing poorly, but it is the IT stocks which are really leading this decline. So I'm going to put a few of the larger names up on your screen, and you can see the kind of cuts that we've got across the tech space. So that entire sector definitely in focus. The metals pack also looking quite weak. So whether it's a Tata Steel, JSW Steel, all of these are sharply lower. And if you're really trying to look for some green in this market, then you can perhaps look at the FMCG stocks, those ones. And that sector is actually the only one which is managing to keep its head above water. Of course, take a look at Reliance because we do have the AGM today. There's a lot of focus on, what the listing plans for the individual businesses will be. So we're watching out for that. We're also going to look at the succession plan. So any Q on that is what the street is watching out for. Reliance has moved into the green. So that is another support for this market. But Sumaira, for now, we can perhaps take some light of the fact that even though we saw a sharply lower start, we've recovered around 140 points from there.
Okay, so let's take it to our first guest then. Ken Peng, who's the Asia-Pacific investment strategist at Citi Private Bank, joins in to make sense of all that's happening globally. Hi, Ken. Morning. Thanks very much for joining in. So we've seen the Fed chief warn that there would be high interest rates persistently for some time now. So what do you make of the future trajectory? Do you think 75 basis points is not ruled out now at the next meet?
Yeah, well, look, I think September, the odds are moving more towards the 75 basis points. We still have to wait to see what the payrolls and the inflation numbers show, but I don't think it's going to make that much of a difference unless it comes in as a big shock. But I have to say though that the Fed is kind of forced to say what it is saying now, and how the rate situation pans out later on, especially into 2023, I think still depends a lot on the data.
As we pointed out, the two important data points will be on Friday, the non-farm payrolls data, and then on 13th of September, the U.S. inflation print for the month of August, and both these two will feed into the September FOMC meet. So Ken, you would bet on 75 basis points?
Yeah, I think that's probably becoming the more likely scenario, right? The Fed, interestingly, the Fed will do whatever the market tells it to do the night before the actual meeting. So we'll see where the consensus is, how they interpret the data, and the Fed probably will oblige.
How much of the mid-June rally that we saw globally, and global indices rallied between 15% up to even 20%, even markets like India had a phenomenal rally in the last 2 months. How much of that was predicated on a dovish Fed, a Fed pivot, or the Fed even pausing? And in that context, given what we've heard from Jay Powell, how much are we likely to give up in terms of gains? What could be the extent of retreat from here on? 5%, 10%, or even more?
So the rally, I think, is predicated on something that was impossible: a dovish Fed and strong economy. So continued profit growth plus dovish Fed. So that's kind of too optimistic. So now I think we have to deal with the fact that the Fed will remain hawkish until the economy fails, or recession comes, right? And so I think the prospect for equities is probably poorer. I would not be surprised at all if all of the rally since June were given up.
All right. Ken, good morning, and thanks a lot for joining us. I mean, absolutely right. I mean, even before this, a lot of the Fed members were sounding very hawkish. Fundamentally, nothing really has changed in his speech, and even the dovish Fed members were sounding quite hawkish in the days leading up to Jackson Hole. But considering the fact that, right now we are factoring in a 75 basis points hike at the September meeting, do you think that with this, most of it is already factored in, or do you think we could see a very sharp fall after that? How much of the 75 basis points, do you think is already factored into the markets?
Look, I mean, September is it's important, but it's not pivotal to me. What is pivotal is how will the economy react to the Fed tightening that's already happened, and the rate hike plus QT that's still to come, right? Because remember, in September, the Fed has promised to double its quantitative tightening size from 47.5 to 95 billion per month, and that's something that the market has not really experienced before. And so I think the liquidity situation beyond the September meeting is the key question here, in addition to where the rates might go.
So Ken, then how are you looking at especially Asian equities, and within that, say, the Indian market, and also with regards to the dollar, which we're likely to see strengthen from here on? What is the upside to your mind?
Yeah, so I think to the extent that Fed remains hawkish, until the economy shows more signs of weakness, perhaps towards the end of this year, we have this few months ahead of us that could be strong dollar, rates staying elevated, and risk sentiment quite shaky. So I think in that environment, those markets that are more sensitive to the dollar and interest rates, and I think India is one of them, are likely to be more vulnerable. Yeah.
Talking about markets being more vulnerable, you made a point. You said that you would not be surprised if global markets give up their entire rally from mid-June. For the Indian markets, it means a Nifty level of 15,000, 15,500. Is that your base case scenario? We head down to those levels? And do you think at that point it's a bottom? And how would you approach it from a portfolio point of view? What's the call?
Look, I sorry, but I don't make point forecasts. I think where we were back in the middle of June was I think a full cycle Fed tightening priced in, plus a little bit of recession priced in. Now, that's just not the case, right? So next year, looking at U.S. Earnings per share, we're looking for a 10% decline. The consensus at 8% plus growth, and so I think the gap between the market and expectations is fairly large, and I think investors should be focusing very much on quality. You want to make sure that the companies, if you're holding equities, the companies that you're holding have stable earnings, have the ability to grow earnings and keep dividends through downturns. And aside from that, we're still overweight, most heavily overweight in investment grade bonds, as well as U.S. Treasuries.
All right, Ken, if I can, come back to the Indian markets. We have been, of course, talking about all of these inflation concerns, recession, what's going on with crude. In spite of that, our markets have really sort of gone ahead and just managed to climb every single wall of worry. And we're not that far away from the all-time highs as well. So we've also, by the way, seen all of the flows come back in August. Do you think that is something that could sustain? And in that context, where would India lie in your pecking order?
We at this point we tend to be fairly defensive in nature, so we don't like markets that are fully priced, and so we have a neutral allocation to India. We have underweight in U.S. equities, and we have underweights in global equities in general, and biggest overweights in fixed income.
Okay, so underweight equities in general and overweight fixed income. Ken, it's a pleasure speaking with you, but unfortunately we're out of time right now on the show. But thank you very much for joining in. Get into a break on that note. On the other side, Reliance Industries will hold its 45th annual general meeting in the afternoon. 2 p.m. is when it starts. We get you the key expectations after this short break. Stay tuned.
Hey guys, welcome back. You're still tuned into Trading Hour. Now, the big cue for today will be the 45th annual general meeting of Reliance Industries, which is going to take place this afternoon. We have our entire research team standing by to tell you what we can expect today and what is everything that you should be watching out for. First up, Nisha is joining us to take us through all of the expectations from this mega event. Nisha.
Let's take a look at the big picture. Now, the AGM has been a big affair for the conglomerate Reliance Industries since time immemorial, and the promoters have often made some high-voltage announcements to its large shareholder base. Now, as a large diversified group, this year is the year of capital expenditure in the new energy business, on which, remember, Mukesh Ambani had made a big bang announcement last year of a whopping $10 billion of investments in 3 years. Now, an update on how much has been committed and what lies ahead will be the key to watch out for. Now, the telecom vertical Jio has been preparing for its 5G rollout plan, especially after the spectrum auctions are over, is an important milestone for the group. And also, Jio milestones are important as the company shows signs of steps being taken to prepare for an eventual IPO. Now, the investors in Jio platforms have already been waiting for their value unlocking through a listing. Similar is the case with Reliance Retail with its large investor base. Now, Mukesh Ambani, remember, had announced the IPOs will be done in 5 years in his 2019 AGM, and next 2 years could be quite eventful on the IPO front. Now, big talking point in Reliance Industries is the next gen taking over important executive roles in the group companies. We see the succession plan unfold slowly over the next year. First step, remember, in this direction has already been taken with Akash Ambani taking over as the chairman of Reliance Jio Infocom. Isha Ambani on retail and Anant on energy to follow. Reliance has taken many steps to be viewed as a truly global company, and therefore the aggressive target of being net carbon zero by 2035 is also in the works. Its progress also adds to the premiumization of its equity and perception building on the global stage. So all eyes on Mukesh Ambani's speech at the AGM.
All right, Nisha, thanks very much for that. Also, Reliance's latest venture has been the new energy business, and Sonal is here to tell us what the market will be watching out for from the energy space. Sonal.
While the big focus in the AGM is expected to be on the new energy business, company has already completed acquisition and investments to the tune of 5,500 crores so far to build capabilities in the new energy value chain and created multiple subsidiaries last year just for the new energy business. In fact, in the annual report, company focused extensively on the plans in green energy space. Renewable appeared 65 times in the report itself. Company said that India will have the world's most affordable green energy within this decade itself. And over the next 12 months, green energy investments made by Reliance will start going live. And new energy will outshine the existing growth engines in just next 5 to 7 years. So in terms of expectations, more details and potential timelines in terms of execution will be watched out for under various projects, and greater clarity on new energy capex will surprise the market positively. On the oil to chemicals bit, company mentioned how FY22 saw a lot of volatility in the energy market, but Reliance Industries has been able to weather that. So company's strategy in FY23 is something we'll watch out for. Company also spoke about how in this segment particularly, they have been optimizing costs. Additionally, if there is any clarity on either the listing or potential stake sale in the oil to chemicals business is something we'll be watching out for. And lastly, company has plans of decarbonizing the O2C value chain, and the capex plan here will give some more clarity to the investors as well.
All right, Sonal, thanks a lot for taking us through all of the expectations from the oils to chemical business. But we also have Mangalam now. So Mangalam, tell us, what can we expect from the retail vertical?
Well, FY22 was a tough year for the industry at large as we were battling through multiple waves of COVID as well. But in that, Reliance Retail actually did well, reported record revenues and EBITDA. And importantly, you saw the company invest in the future as well. The revenues neared that 2 lakh crore mark, and the company added 1.5 lakh jobs as well. Some of the key milestones that the company achieved: 2,500 new stores added, almost 8 million square feet of retail area added, of which nearly 3/4 were in tier 2 and beyond cities and not just metros. They doubled their warehousing capacity, as well as registered customers increased by 24% in FY22 as well. At the back end too, we saw a 3 times jump in their merchants, and digital now contributes 17% to their revenue versus just about 10% odd. But the big headline was the near 10,000 crore investment that the company did in a lot of companies, minority, majority, as well as strategic. So starting with companies like Just Dial, 7-Eleven, Milk Basket, Clovia, tie-ups with brands like Ritu Kumar, Manish Malhotra, the who's who, Abraham Thakur, we had Abu Jani and Sandeep Khosla as well, and notwithstanding the $200 million investment that we saw in quick commerce player Dunzo as well. So to that extent, announcements would be extremely crucial to watch out for. As we speak, Reliance is the 56th among top global retailers and the second fastest growing retailer in the world. And remember, the previous AGM, Mukesh Ambani had said that they would grow at least 3 times over the next 3 to 5 years, and importantly will be among the top 10 retailers in the world. So that's about Reliance. Any announcements in the AGM with regards to that, the digital ecosystem in the retail business, value unlocking will be extremely crucial to watch out for, and expansion of retail offerings and synergies between the acquisitions that the companies made. They've made the investments. Now it's time to reap them.
All right, and let me take that cue and talk about telecom on what we can expect on the 5G business. Well, 5G-related announcements are expected to take center stage at the AGM. Remember, Reliance Jio spent a whopping 88,000 crore in the recently concluded auctions, which was twice of that of its closest peer Bharti, and they even lapped up that expensive 700 megahertz spectrum, which went unsold in the previous auctions. In terms of specifics, expect clarity on the rollout timelines of Jio. The annual report highlighted how Reliance Jio had already completed its plans for coverage, customer demand, revenue potential to launch 5G in the top 1,000 cities in India. And its aim, which it outlined in the last AGM, was to make India 5G yukt. So what is going to be the rollout timelines, how many cities it's going to cover, and even in terms of tariff. The AGM is also often used as a launchpad for new JioPhone releases. In the last AGM, the company showcased JioPhone Next, the world's most affordable full touchscreen 4G phone in collaboration with Google. In this AGM, the big question is, will Reliance Jio talk about, hint or announce the launch of the company's first 5G Jio phone, and how affordable will it be? Another event that everyone's going to be tracking very closely is that Nisha also alluded to, will we get any update on the timeline for Jio's IPO at the upcoming AGM? And that will be a big one. He's already got the ball rolling in terms of succession planning by appointing Akash Ambani as the chairman of Reliance Jio Infocom. So spin-offs and succession will be watched very closely. Just want to put in context the size of Reliance Jio now. Its annual operating revenue for Jio platforms crossed $10 billion last year. Jio's network carried almost 10% of the global mobile data traffic in calendar year 21. Its subscriber base is well over 400 million. Jio Fiber, that's the home broadband, they had 5 million plus connected homes, and it's become the largest fixed broadband provider in India within just 2 years of launch. But with that, we're going to wait for the actual announcements to come through at 2 p.m. With that, get into a break. On the other side, we'll discuss market technicals. Gaurav Ratnaparkhi of Sharekhan joins. Welcome back. Holding above 17,300, 17,330 to be precise, a cut of 1.3%. But there has been a substantial recovery, more than 150 points from the day's low. And it's all to do with the resilience of the FMCG pack, Tata Consumer, HUL, Britannia. These are the top three Nifty gainers, and Reliance Industries too has recovered nearly 2% from the day's low. Good time to get in a tech check. Gaurav Ratnaparkhi is now with us. Gaurav, any trade on the Nifty, and what would your stock picks be?
Yeah, sure. So basically, Nifty is witnessing third leg of the short-term correction today. It had entered short-term correction mode from the level of 18,000. And after the first leg of the downside, the index attempted a minor degree bounce back in the last week that retraced 61.8% of the first leg of the decline. And from that crucial Fibonacci level, we are seeing this next leg on the downside. And on the way down, Nifty has broken the swing low of 17,345. So an intraday bounce to retest that low of 17,345 is actually an opportunity to initiate fresh short position. So traders can initiate fresh short position at this level with stop loss at 17,500. And on the downside, 17,000 will be the target to watch out for. Similarly, in the case of Bank Nifty also, the index attempted a minor degree bounce back in the last week. It was a bit deeper. The index retraced 78.6% of the first leg of decline, and from there we are seeing the index tumbling down. So for Bank Nifty, 38,400, 38,500 will be the zone where one can initiate fresh short position with stop loss of 38,800, and on the downside, 37,500 will be the short-term target. And in terms of stock-specific action, I have picked up one on the long side and one on the short side. On the long side, I have picked up HAL. Basically, our outlook is positive on the defense counters. And this particular stock, HAL, has seen a minor degree correction recently. It has nicely formed a base near 2200 mark in the last week. And over there, it formed an inside bar pattern and has broken out on the upside. So basically, it has resumed its larger uptrend. Even the early momentum indicator got an opportunity to cool off and start a new cycle on the upside. So HAL is looking quite attractive at this level. A buy with a stop loss of 2200, and on the higher side, 2400 and 2500 will be the short-term targets. On the short side, I've picked up a banking counter. As we discussed, banking stocks are looking weak. And this particular stock, Kotak Bank, attempted to cross 1900 mark multiple times, but could not sustain in the higher territory. Basically, the Delhi upper Bollinger Band is contracting, and that is keeping pressure on the higher side. So Kotak Bank can test its Delhi lower Bollinger Band and can go even lower. So sell on Kotak Bank futures with stop loss of 1910, and on the downside 1800 and 1750 will be the targets.
All right, Gaurav, thanks a lot for joining us and taking us through those individual recommendations. With that, we're going to get into another short break. But when we come back, V. Kalyana Rama, Chairman and Managing Director of Concord, will be with us to discuss their outlook going forward.
अरे भाभी जी बड़े दिन बाद
मुझे बेस्ट डायमंड ज्वेलरी दिखाओ।
ये एक्सचेंज करा लूं?
बेटा एक्सचेंज में ज्यादा
नहीं, सिर्फ 5% कटेगा।
वाह!
पेश है 95% एक्सचेंज वैल्यू और 90% बाय बैक भी। किसना डायमंड ज्वेलरी।
I always go for it. आप भी जरूर ट्राई कीजिए। Toodles guys. Good recommendations are helpful ना? They surely help me while investing with Angel One. आखिर influencers को भी तो जरूरत है smart recommendations की।
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.
अबे, मेरे लिए कुछ नहीं बचाया। बचाया ना? सिस्का BLDC फैंस ने 60% पावर बचाया, पैसे बचाए, प्लैनेट बचाया। BLDC मोटर, more savings, more powerful, more eco-friendly. अबे तुम बचाओ। Siska fans, light years ahead.
Siska. There are those who are always looking for what's next. Changing lanes, shifting modes, always in command. Sensing what lies ahead. The all-new Hyundai Tucson Next drives now.
Hey guys, welcome back. You're still tuned into Trading Hour. We have a management waiting by. Concord is in focus. The stock is up around 12% this year. We have Mr. V. Kalyana Rama, who's Chairman and Managing Director of Concord, joining us now to discuss the way forward for the company. Sir, very good morning and thank you very much for joining us. This is Pavitra. I'm going to come to all of the financials in just a minute, but if I can start with the land license fee. What is the latest? Have you heard anything yet on that front? And your Q1 was at around 95 crores. So can you tell us what you are expecting for the full year?
Yeah, full year, as we gave the forecast, it is around 450 crores. So a little bit here and there, but we go with that target. It's a 6% of the market value of the land. So last year also it's the same land licensing fees. So this year it is continuing. As of now, there is no change in that policy.
It was expected that, we were hoping that it would go down to around 3%. So you've not heard anything on that front at all about a decrease from 6 to 3%?
So that's, yeah. As of now, the policy is the same. It is 6% of the market value, industrial market value of the land. That's very clear. There is no doubt in that. So if at all there is any revision, definitely it will be notified to everyone. As of now, there is no revision.
Absolute number you're saying will be 450 for the full year?
Yes, 450 crores. That's what our estimated. We estimate that, okay. And that is where we keep our books. So we keep some provisions and all that. So there's a little bit of calculations. So industrial values, the revenue authorities, they will be fixing up. There may be some changes somewhere. So we got 27 locations. So we keep these things updating every time. So every 6 months, land revenue authorities, they change their land value. They continue with the same land value, or they may revise upwards or downwards. So it is an approximate figure that 450 crores per year will be the land license fee for the railway land we are holding.
And how much of this 450 crore have you provided for?
That is already there is in the first quarter balance sheet, isn't it? So there's already, we provided the 1/4 of it. There is, so there will be a little bit of adjustments in the balance sheets. So when you look at the final figure in the year, that is what I am giving you the estimate, it will be 450 crores. So it will be provided in equal tranches. So the 4 tranches. So we have already provided for one, for the quarter 1, then we will be providing for the other 3 quarters, and in the final balance sheet, it will be adjusted as per the land values notified by the revenue authorities.
Good morning, Mr. Kalyana Rama. In terms of your guidance for FY23, I believe you have said there'll be, in terms of volumes, over 5 million TEUs, right? But while the EXIM portion is the bulk of this in terms of numbers, but the incremental growth is coming from the domestic business, right? So can you give us a sense of how in FY23 this might pan out? Do you expect the export-import segment to pick up once again, and by how much? As well, how much can domestic continue to contribute?
Yeah, it's a very good point you raised. So let me come out on this. See, the domestic growth, what we have seen last year, is around 35%. And after that growth, again this year we are witnessing almost 30% plus growth in the domestic. So this shows that the containerization trend is picking up in India. Compared to the developed markets, the containerization in India is slightly on the lower side only. So there is a good scope for containerization to pick up. As well, we are started giving some good business solutions, the logistic solutions to the industry. One such I discussed earlier also, the cement movement in normal containers, bulk cement movement. So movement of these commodities in bulk in normal containers, whereby we can reduce the logistics cost, not utilizing a special type of container, is going to be a game changer, and it is going to give us volume. So now that segment has not yet picked up, let me tell you. The growth 30% which is coming out of the traditional goods we were carrying for last 5, 7, 10 years. Now these new cargo lanes we are starting will give a further boost to the domestic market. So we are expecting good growth in domestic segment. So that is why what we did, we already released 18,000 containers manufacturing order for Indian manufacturing firms. Here we are trying to develop India as a container manufacturing hub. So we gave 6,000 containers order as a development order to 4 firms. Then we released one global tender, and I am very happy that one Indian firm has backed this order, which is located in Gujarat, all 10,000. So that also we released. So we are expecting a good growth in our domestic demand, and we want to pick up containers. Because today we are holding 37,000 of our inventory, trying to add another 18,000 which we released orders, and further we will increase. And maybe something like we are looking at a figure of 1.5 to 2 lakh TEUs to hold in the domestic segment in next 4 to 5 years. That is the sort of demand we are envisaging in the domestic market. So this gives a CAGR of maybe around 15-20% for 5 years. We expect that sort of demand. Coming to export segment, the imports are still not picked up in India. Exports are doing well. So we are given the scheme of the repositioning of empty containers from port to hinterland, that we are continuing for this full year, giving a 50% rebate, which is helping exporters. So here let me just come to a point where last year when there was a lot of shortage of containers, we used our containers to send some export goods to Iran. So that was a nice experiment, and it was a successful experiment by us. So we will be looking at these things also. So the entire this demand domestic, so we will be connecting some lanes, trying to help some exporters. And export market, I am sure, will pick up because the manufacturing sector in India has started performing. So let's hope that export import also the demand will pick up. As of now, the import is slightly on the lower end.
Okay. Any guidance for EXIM volumes for this year?
Guidance I am not changing because it's still the time is there, and the next 2 quarters we hope the things will settle down and will perform well. So guidance of that 5 million what we are working on, I am not changing at this moment. We are working on that 5 million. So the domestic EXIM proportions may slightly vary by few percentage points. Last year we did 70-30 in our revenues, and in volumes also near that number. So this year maybe domestic may go by another 1 or 2 points, where if EXIM is imports at low ebb. But we are working towards trying to achieve that 5 million TEUs. Let's see, the target we are not revising as of now.
All right, so you're maintaining that guidance for the EXIM growth. If I can also ask you on the margin front, it's been quite flat around 24%. Pre-COVID and, a couple of years ago, FY19, FY20, we did see levels of 26%. When do you think you can go back to that?
See, margins of 24% are very good margins in the logistics industry. So actually now after the COVID, we are trying to help the industry to pick up. So instead of increasing our margins, we are trying to maintain the price lines. Little bit of increase, inflationary increase we did here and there, but otherwise we are trying to maintain the price line to help the industry. So that 24% is a very healthy margin. So that we are not very greedy on going above on this at this moment. So we are trying to help the industry and pick up the volumes.
So we can expect around 24% for this year as well?
Yeah, that will be the thing, yes.
Okay, margins of 24% and the volume guidance is maintained at 5 million TEUs, though it may shift more in terms of domestic volumes rather than exports. But on the whole, the volume guidance remains intact. So what about CAPEX? Could you give us the CAPEX guidance? How much do you think Concord will be spending?
See, CAPEX, other than the containers and rolling stock, this year we will be spending something around 800 crores, 600 to 800 crores, depending on the land availability, which we are working on some terminals. So, but on the containers procurement and rolling stock procurement, we actually planned for almost spending 8,000 crores in next 5 years. That is from the last year onwards, and the program is going on. As I mentioned, 18,000 container order is almost around 700 crores release. So these containers keep coming in the not in the completely in this financial year, but over the next financial year also, and we'll be further releasing. And we are procuring 230 more rakes. Last year we added 33. Now there is some wheel shortage problem in India, so we are trying to import wheel sets. So once we start getting wheel sets, again the rakes start rolling out. So that also we got a program of 230 rakes. That is an investment of almost 4,000 crores. And further containers and further addition of the rolling stock and the handling equipment. This CAPEX is around 8,000 crores over the next 4 years. So overall, if you see next 4 years, we will be spending a CAPEX of around 8,000 to 9,000 crores. So that was the guidance given by me last year, that we will be doing a 10,000 crores CAPEX in the next 5 years.
All right, Mr. Kalyanarama, thank you very much for joining in today, and we hope to touch base with you soon again. All the very best for the coming quarters. A quick break for now, but as we do that, here's a quick reminder for our viewers. It's that time of the year again. Money Control Pro's Financial Freedom Offer. Hi, welcome back. You're watching Trading Hour. Well, throughout the globe, we've seen the markets get spooked actually a little bit by the Fed commentary. But let's take stock now of what it means for our own market. How could we trend from here? Rakshit Ranjan of Marcellus Investment Managers joins in. Hi, Rakshit. Morning. First up, of course, if you can dissect for us the Fed impact for the Indian market and where things could head, say, over the next month or two.
Good morning. Thank you for having me on your show. So, look, I mean, we've gone through too many such macro-related decision-oriented concerns over the last 12 months or so. So let me put it in the following manner. Between, say, Jan and June, for the broader market, whilst the macro was a bit of a concern, there were a few sectors which were receiving significant tailwind, particularly commodity producers and utility companies, etc. That seems to have reversed. Now, as long as interest rates and anything related to macro then is a concern, to begin with, as long as the companies that you are investing in don't have their revenues overly exposed to maybe a slowdown in some of those economies' economic growth, then that's not a concern. As long as the companies you're investing in don't have debt on the balance sheet, and in fact their competition might be either debt funded or cheap capital funded, there's actually improvement in competitive intensity likely. So that's the second way to understand it. In terms of commodity prices, which could be inputs into various companies' businesses, manufacturing, etc. Commodity prices should remain soft if demand for those commodities from the larger economies is a lot more muted in future, so on and so forth. So that's the line of thought that we have. Now, on that basis, I think the best place that you should be probably exposed to as an investor is highly cash generative balance sheets with business models that are not exposed to global demand, and in fact management teams that are capable of benefiting from the external macro volatility by dealing with these external events in a better way than their competitors.
Rakshit, morning. Jay Powell seems very committed to taming inflation, and even though it might have an impact on the demand in the United States, he's willing to take in demand destruction, the hit to corporate America. In that context, do you think corporate profitability is going to be hit more than what the street was anticipating? And is that something which could be a big risk even for the Indian markets?
Yeah, I mean, our understanding is more limited to the Indian markets only. When it comes to the Indian markets, corporate profitability can be a hit from three fronts, right? Either revenue or profitability in terms of operating profits, or maybe ability to service the cost of debt if there is debt on the balance sheet. Those are the three areas where I see a corporate profitability question arising. And that's exactly, I think that there aren't too many high quality companies in India which have revenue exposure to global economies. At a margin level, if you're picking up high quality businesses, then they'll not be exposed to the margin headwinds because they'll have pricing power to pass on those effects, if at all. And finally, at a financial leverage level, if these are cash generative companies, then it's not a concern. And hence, again, going back to the simple framework that I think will help investors deal with this external turbulences. If you're exposed to high pricing power cash generative businesses, then I don't think corporate profitability is at risk. But if you're exposed to highly leveraged companies exposed to a lot of export-import and weak pricing power, then you're probably right. Corporate profitability is at risk.
But Raksha, my question is, if on an aggregate basis, if the Nifty falls, because corporate profitability is going to be hit, even the high quality stocks have a sentiment impact and the stocks may decline 2 or 3%. So they may be resilient, they may fall less than the markets on a whole, but they do end up declining. So my question is more on the big picture in terms on an aggregate basis. What is the view? How do you read the setup? I'm not talking about only the high quality company, the consistent compounders that you have in your portfolio.
Yeah, but at the end of the day, I think that's the only place where you can hide. So let me put it this way: it's very difficult to forecast sentimental hit or corporate profitability hit from a global macro event from a 3 to 6 month perspective. All you can do is you can say that, well, if I'm exposed to a certain sector of stocks where it could be a sentimental hit but not fundamental hit, then I'll buy more of it if it falls. Rather than trying to play the weaker quality plays, which in any case weren't going to compound over the longer term and in the short term might be exposed to such macro risks.
All right, Rakshit, good morning. Is there any sector, any space that you feel that it's just best to completely avoid at this point? And, also how are you looking at what's going on with the IT index and with all of these names? Of course, this is, again, something that we are seeing a reflection of from the global markets. We've seen what's going on with the NASDAQ. So how would you read IT in this context? And also, is there any sector that you would avoid completely staying away from at this point?
Yeah, so wherever you have no sense of competitive advantages. So for instance, many commodity producers, which would certainly be exposed to demand moderation from global economies in the months to come, and they don't have enough avenues for offsetting those headwinds from any other sources. I think those kinds of sectors would certainly be worth avoided. But in terms of IT services, so think about it like this: when it comes to the entire vendor consolidation and cloud migration of applications for corporates all over the world, there is a massive offset available in terms of market share gain prospects for some IT companies against the decline in demand from some of the larger economies of the world. Right, and that offset is actually very meaningful because not many IT services companies can provide high-scaled manpower at cheap prices with high-quality training also imparted to them. Right, this is something that goes against the Cognizants and Accentures of the world and more towards the TCSs and Infosys of the world. Just for disclosure purposes, all of our clients and our families' monies are invested in TCS, not Infosys. in our portfolios. But yeah, that's something worth bearing in mind, that there's an offset available to high quality IT services in India from the macro theme.
Thank you very much for joining in. That's the view coming in on the markets. Get into a break on that note. On the other side, we'll be joined by Anil Gupta, the chairman and MD of KEI. Welcome back. The stock which is on our radar right now is KEI Industries. Mr. Anil Gupta is now joining in. He's the chairman and managing director of the company. Mr. Gupta, morning, and thanks so much for joining in. This is Reema here. You have a significant capacity expansion coming up for the next few years. I think you're planning to invest close to about 800 crore rupees, which can add revenues, incremental revenues of 4,000 crore rupees. Could you outline your capex plans and the big picture? Where do you envisage KEI Industries in the next 5 years?
We expect to start this capex by end of this year, and this will be spread over a period of 3 to 4 years. We want to grow by 16 to 17% CAGR every year, and want to be around 12,000 crore company in next 4 years. That is our plan, and the capex will be spread, and it will be on the existing product line in low tension, high tension, and extra high voltage cables. We have significant capacity available in house wire segment to grow further. And also we'll be putting some, brownfield capacity in, in our winding wires and other, retail products in the cables.
All right. Good morning, Mr. Gupta. Thanks for joining us. So capex will start at the end of this year. Talking about your order book, the last figures we have are of around 2750 crores. Can you tell us what is the timeline of this? And also, what can it mean for your revenues for your full year? For Q1, your revenues were around 1500 crores. So what is the full year revenue that we can expect?
See, the order book position is around the same level, because we are executing most of the orders within maximum 3 to 4 months, especially for the cables, other than the EPC orders. And so far as, revenues, overall revenues in this year, we can expect, I can't give absolute number, but I'm expecting a growth of around 16 to 17% compared to last year. This is a broader revenue guidelines, and we expect that we should be able to maintain it.
Okay. So this 12,000 crore of a revenue target would be FY27?
Yes.
Okay, FY20. And what would be the margin target?
See, presently our margin is hovering between 10 to 11%. And we expect that if everything goes well, we should be able to expand the margin by around 1%.
So it should be closer to 11 to 12%, right?
Correct.
Okay. So you also are currently, your products are currently priced cheaper than your competitors like Havells, Finolex. Do you have plans to reduce this? To bring it at price parity? And if yes, by when? And is that going to be the margin driver for you over the next 4 years?
Yeah. As we are, pursuing and, going deeper into the retail and building up our brand, we would like to expand our margins in the retail business, as the B2B business is always competitive, and the pricing is definitely not our hand. But in retail business, by our broader, penetration, we should be able to expand the margins by 2 to 2.5% in next 2 to 3 years. And that will expand the overall margins. As it is, our interest cost is going down. That is also improving our margins overall.
Okay, so this is actually a trend that we have been seeing, where retail as a percentage of your sales has been going up. It was at around 28% in FY18, and it's currently at over 40%. So can you tell us what is the target that you see for the retail business for contribution to sales?
See, last year it was around 42% of the overall business. Even in the first quarter also, we have seen 42% around. We would like to take it to 50% level in next 1 to 2 years. And even going forward, we would like to take it to 55 to 60% by FY26-27.
Mr. Gupta, would have loved continuing this conversation, but we're out of time. Thank you very much for joining in. But we'll keep chatting with you on this 4-year plan that you've outlined for us, where revenues will hit 12,000 crores and margins will expand by nearly 1 percentage point on a consolidated basis, led by increased margins in the retail business. That's KEI Industries for you. The stock has moved up nearly 1%, is now at the high point of the day. Well, with that, we're completely out of time on trading hour. The markets are still down about 1.3%, so pretty much where it was at the start of the show. Halftime report is up next.